Hello, welcome to Capital Sensei. Today we're going to dive deep into one of the most influential investment books ever written, How to Make Money in Stocks, by the legendary investor William J. O'Neill. We'll break down his famous Canslim method, a powerful system that combines the best of both worlds, a company's fundamental health and the technical action of its stock price. This is the blueprint that helped O'Neill and countless others identify monster stocks before they made their biggest moves. Whenever we can, we try to answer questions in the comments section below the video. So, as we go through this, if anything sparks a question, or if you have your own experiences with this strategy, please share them. Your stories and questions help create a community where we can all learn from each other. All right. Let's get started. William O'Neill wasn't just guessing. He conducted one of the most exhaustive studies of the stock market's biggest winners, going back decades. He analyzed the stocks that made astronomical gains, looking for common characteristics they all shared before they took off. He was like a detective, looking for a specific DNA profile. And what he found was a 7-part pattern, a checklist he brilliantly named Canslim. It's not just a catchy acronym. It's a rigorous, disciplined approach to finding elite growth stocks. The C in Canslim stands for current quarterly earnings per share. This is the first and, for many, the most critical test a stock must pass. We're looking for a dramatic increase in the most recent quarter's earnings per share, or EPS, when compared to the same quarter from the previous year. O'Neill wasn't interested in small, boring increases of 5 or 10%. He wanted to see a real explosion. We're talking about a minimum of 18 to 20%, but ideally, you want to see growth of 40, 50, or even 100% and more. Think of it this way. If you're deciding which restaurant to invest in, you don't just care that it was good 5 years ago. You want to know if it's packed tonight. Are people lining up out the door right now? That's what a huge jump in current quarterly earnings tells you. It signals that something very positive is happening with the company at this very moment. Perhaps a new product is flying off the shelves, or their service has suddenly become the industry standard. This is the immediate, real-time sign of success that precedes a major stock price move. It's also crucial to look for acceleration. It's a great sign if a company's earnings grew by, say, 20% a few quarters ago, then 35% last quarter, and now 50% in the current quarter. That's a company hitting its stride. It's like a race car that isn't just fast, but is actively getting faster with each lap. This kind of acceleration often catches the big institutional investors by surprise, and as they rush to buy in, they drive the stock price up significantly. Now, let's move on to the A, which stands for annual earnings growth. While the C looks at the company's recent sprint, the A checks its marathon running ability. O'Neill insisted that the best companies show a strong and consistent track record of annual earnings growth over the last 3 to 5 years. This demonstrates that the recent quarterly success isn't just a fluke. It's built on a solid foundation of sustained performance. What we're looking for here is an average annual earnings growth rate of 25% or more. This proves the company has a durable business model, a strong competitive advantage, and management that knows how to execute year after year. It's like checking a student's full academic record. A single A on one test is nice, but you want to invest in the student who has a history of straight A's for several years running. This shows a pattern of excellence. A company that can consistently compound its earnings at such a high rate is a wealth-creating machine. Each year, it has a bigger pile of profits to reinvest into research, expansion, and innovation, which in turn fuels even more growth in the future. This is the magic of compounding that creates the truly life-changing stock market winners. So while the C gives us the wow factor, The A provides the confidence that this company is the real deal. The third letter, N, is one of the most exciting. It stands for new products, new management, or new highs. This is the catalyst, the spark that ignites the fuel provided by strong earnings. The greatest stock market runs are almost always preceded by something new and transformative happening within the company or its industry. Think about Apple in 2007. The C and A were there, but the N was the iPhone. That was the game-changing new product that propelled the stock into the stratosphere. A new product or service can open up massive new markets and create a surge in revenue and earnings that wasn't there before. But the N isn't just about products. It can also be about new management. A brilliant new CEO can come in and completely turn a company around, cutting costs, streamlining operations, and inspiring a new culture of innovation. It's like a struggling sports team getting a legendary new coach who leads them to a championship. Finally, and this is a part that trips up many investors, N also stands for new highs. Most people are taught to buy low and sell high. It feels safe to buy a stock that's been beaten down. But O'Neill's research showed the exact opposite. The stocks that go on to make the biggest gains typically break out to new 52-week price highs before they launch their major advance. Buying a stock as it makes a new high is a sign of strength. It means the stock has momentum, and there's huge demand for it. It's like betting on the horse that's already leading the race, not the one that's trailing in the back. The next letter in our system is S, which stands for supply and demand. This is pure market economics at its finest. The price of anything, whether it's a loaf of bread or a share of stock, is determined by the balance between how much of it is available and how many people want to buy it. For a stock price to make a big move up, you need large demand combined with a relatively limited supply of shares available for purchase. O'Neill found that many of the best performing stocks were companies with a smaller number of shares outstanding, what's often called a smaller float. Think of it like a limited edition art print. If there are only 100 prints in existence and 1,000 people want one, the price is going to skyrocket. It's the same with stocks. A company with, say, 25 million shares is much easier to move up than a behemoth with 1 billion shares. A surge of buying from a few big funds can have a huge impact on the price. Another key aspect of S is looking for signs of heavy demand from big players. We want to see large institutional investors accumulating shares. One way to spot this is by looking at the stock's trading volume. When a stock's price rises on a day with much higher than average volume, it's a clue that big money is buying in. Conversely, you also want to watch out for signs of heavy selling. A stock dropping in price on massive volume can be a red flag. O'Neill also liked to see companies with management that owned a significant amount of stock and companies that were actively buying back their own shares on the open market. A share buyback reduces the supply of stock, making each remaining share more valuable. Now we arrive at L, which stands for leader or laggard. In any industry, there are a handful of true leaders and a whole lot of followers. O'Neill was adamant, you must invest in the leaders. You want to own the number 1 or number 2 company in a strong industry group. These are the companies with the best products, the strongest earnings, and the most respect from Wall Street. They are the innovators, not the imitators. A common mistake investors make is what's called a sympathy play. A certain sector, let's say cybersecurity, gets hot. The leading cybersecurity stock soars in price. An investor might think, wow, that stock is too expensive for me now. I'll buy this other, cheaper cybersecurity stock instead. It will probably go up too. This is almost always a losing strategy. The laggard is cheap for a reason. It's the weaker company. You're better off paying up for quality and buying the true leader. So, how do you identify a leader? One of O'Neill's key tools was the Relative Strength Rating, or RS rating. This is a number from 1 to 99 that measures a stock's price performance over the last 12 months, compared to all other stocks in the market. A stock with an RS rating of 95 has outperformed 95% of all other stocks. O'Neill insisted on only buying stocks with an RS rating of 80 or higher. This ensures you're fishing in the pond of the market's strongest performers. The leaders are the ones with high RS ratings, leading their industry in price action. Don't settle for the second best. The sixth letter is I, for institutional sponsorship. This is one of the most important forms of validation a company can get. Institutional sponsors are the big players in the market: mutual funds, pension funds, hedge funds, banks, and insurance companies. These institutions have entire teams of highly paid analysts whose full-time job is to research companies. When they decide to buy a stock, they are putting millions, sometimes billions of dollars to work. Their investment is a massive vote of confidence. Having a number of well-respected institutions owning a stock is a huge positive. It's like wanting to buy a used car and finding out that 3 of the best mechanics in town have already inspected it and given it a thumbs up. It provides a level of professional due diligence that the average individual investor simply can't replicate. O'Neill suggested looking for a company that has at least a few, and preferably an increasing number, of institutional owners. Specifically, you want to see sponsorship from the better-performing funds, as they have a track record of picking winners. However, there's a crucial nuance here. You don't want a stock that is overly owned by institutions. If literally every fund already owns the stock, who is left to buy it and push the price higher? It's like a popular nightclub. You want to get in while it's getting popular, but before it hits maximum capacity and the fire marshal shows up. If a stock is already owned by hundreds and hundreds of funds, it might be over-owned, and the big money has already been made. The sweet spot is a company that is gaining institutional sponsorship, but still has room to grow. Finally, we come to the M, and it might be the most important letter of all. M stands for market direction. You could find a stock that perfectly fits all the criteria from C to I. A perfect company with soaring earnings and a great new product. But if the overall stock market is in a major downturn or a bear market, your perfect stock is still likely to fall. As O'Neill famously said, 3 out of every 4 stocks move in the same direction as the general market. Think of the overall market as the tide. You can have the strongest, fastest, most beautiful boat in the harbor. But if the tide is going out, your boat is going down with all the others. Trying to make a lot of money by buying stocks during a bear market is like trying to swim against a powerful rip current. It's exhausting and usually futile. The smartest thing to do is wait for the tide to turn and start coming back in. O'Neill developed specific techniques for determining the market's health by studying the daily price and volume action of the major market indexes, like the S&P 500 and the NASDAQ Composite. He looked for specific signals, like a follow-through day, to confirm when a new uptrend was beginning. The key takeaway is simple. You need the wind of a bull market at your back. The biggest profits are made when you buy the best stocks during a healthy market uptrend. When the market is in a confirmed downtrend, the safest place to be is often in cash, preserving your capital for the next opportunity. So, that's the Canslim system in a nutshell. It's a comprehensive checklist for finding the super performers. But knowing what to buy is only half the battle. You also have to know when to buy and just as importantly, when to sell. O'Neill was a master of using stock charts to time his entries and exits. He wasn't just randomly buying a great company. He was buying it at a very specific moment when it was poised to break out. The most famous chart pattern he identified is the cup with a handle. Imagine the price of a stock on a graph. First, it forms a rounding bottom shape, like the letter U, which forms the cup. This typically takes at least 7 weeks to form. This consolidation period is healthy. It allows the stock to shake out weaker investors and build a solid foundation. After the cup is formed, the stock will often drift down slightly on low volume, forming a handle. This handle is the final, small shakeout before the big move. The ideal buy point, what O'Neill called the pivot point, is when the stock breaks out above the top of the handle, and it does so on a big surge in trading volume, ideally 50% or more above the average. This breakout is the starting gun for the race. It's the signal that the stock is ready to begin its major advance. Buying at this precise moment gives you the best chance of catching the bulk of the move while defining a clear point where your thesis would be wrong. And that brings us to the single most important rule in all of investing, according to William O'Neill. It is not about picking winners. It is about managing losers. His number one rule was this: always cut your losses at 7 to 8% below your purchase price. No exceptions, no questions asked, no hoping it will come back. This is not an emotional decision. It is a mathematical rule of survival. Let me explain why this is so critical. A loss of 8% is relatively easy to recover from. You just need a gain of about 8.7% on your next investment to get back to even. But if you let that loss grow to 25%, you now need a 33% gain just to break even. If you let it fall to 50%, you need a 100% gain. You have to double your money just to get back to where you started. Letting small losses turn into big ones is the single fastest way to blow up your account. Think of it like being a boxer. You're going to take some punches. It's part of the game. A good boxer knows how to absorb a jab and move on, but you cannot afford to take a knockout punch. The 7 to 8% stop-loss rule is your defense against that knockout punch. It keeps you in the game. It preserves your precious capital so you can live to fight another day and find the next great winner. Ego and hope have no place here. Discipline is everything. The flip side of cutting losses quickly is the second great rule: let your winners run. Amateurs have a bad habit of doing the exact opposite of what they should. They hold on to their losers, hoping they'll come back. And they sell their winners as soon as they have a small profit, afraid of losing it. This is like watering your weeds and cutting your flowers. O'Neill's research showed that the big money is made by riding a winning stock for a long time. You need to have the patience and conviction to hold on to your big winners as they appreciate 20, 50, or even 100% or more. A good rule of thumb O'Neill suggested is that if a stock shoots up 20% very quickly from your breakout buy point within just a few weeks, you should try to hold it for at least 8 weeks. These quick movers are often the biggest winners of all, and you don't want to jump off the rocket ship just after it has launched. Of course, no stock goes up forever. You do eventually have to sell and take your profits. The key is to sell for the right reasons, not out of fear. You should be looking for signs of a top, which are often the reverse of the signals you use to buy. For example, you might see the stock making a new high, but on very weak volume, a sign of exhaustion. Or you might see it break down through a key support level on massive, heavy selling volume, a sign that institutions are dumping their shares. These are objective sell signals, not emotional ones. Let's try to put this all together with a hypothetical example. Imagine it's a few years ago. You notice the overall market is in a healthy uptrend, so the M is a green light. You start screening for stocks. You find a company, let's call it Innovate Corp. You check its earnings. Its most recent quarterly EPS is up 60% year over year. C. Its annual EPS has grown at 30% a year for the past 4 years. A. The company just released a revolutionary new software that is getting rave reviews. N. You check its chart and see it has an RS rating of 92, making it a clear leader in its industry. L. The number of top-tier mutual funds owning the stock has doubled in the last 2 quarters. I. And it's a relatively young company with a manageable number of shares outstanding. S. This stock checks every single box of the Canslim criteria. It looks like a potential monster. You don't just buy it right away. You watch its chart. You see it has formed a beautiful cup with a handle pattern over the last 10 weeks. You identify the pivot buy point at $100 a share. You wait patiently. Then one Tuesday morning, the stock pushes through $100. You check the volume and it's running at double its normal pace. That's your signal. You buy the stock at $100.01. You immediately set your mental stop loss at $92, an 8% loss. The stock takes off. In 3 weeks, it's trading at $125. You're tempted to sell and lock in that quick 25% gain. But you remember the rule to let your winners run. You hold on. Over the next 6 months, the stock continues to climb, eventually reaching $200. Now you start to see some warning signs. The stock tries to make a new high, but the volume is drying up. A week later, it breaks below its 50-day moving average on the heaviest volume you've seen in a year. That's your sell signal. You sell your entire position, locking in a nearly 100% gain. That is the Canslim methodology in action. What O'Neill created was more than just a stock-picking formula. It's a complete philosophy for managing a portfolio. It's about combining rigorous, fact-based research with disciplined execution. It teaches you to focus on the best of the best, the true market leaders that are driven by powerful earnings growth. It forces you to align yourself with the overall market trend rather than fighting it. And most importantly, it instills the 2 pillars of long-term success in the market: ruthless loss cutting and patient profit taking. This system removes a lot of the emotion, guesswork, and hope that derails so many investors. It replaces it with a clear set of rules and a process to follow. It's not easy. It requires homework, diligence, and the emotional fortitude to stick to the rules, especially when it comes to cutting a loss. But for those willing to put in the work, the principles outlined in How to Make Money in Stocks provide a timeless and powerful roadmap to navigating the complexities of the market. It's a masterclass in finding and riding the market's greatest growth stories.